It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group.
All right, welcome back. Here we go. Welcome back, Cotter. You know, not to keep dating myself and talking about age, but I did that the other day. I said that to somebody who was in their 40s.
And they had no idea what you were talking about.
It was a slip. I don't usually say things like that. Somebody said, welcome back, and I said, welcome back, Cotter. And what? You know, nothing. Not an ooh, you know.
Don't go there.
I shouldn't. Anyway, Professor Plum, Rick Plum, the certified financial planner professional, here with me, Johnny Dean, your podcast host. That was the other one. I ran into somebody who was, they said they were in their mid-70s. They looked at my name and they said, oh, John Dean, are you the Watergate guy? And I said, you know what? I heard that over and over and over back in the 70s and 80s and even in the 90s. And I said, oddly enough, I get that almost never.
Anymore.
Maybe once a year anymore.
Well, you got it twice then, because I was telling you about a story with a group of people over the weekend.
Yes.
We had a barbecue, we were watching the games, and we were talking about different things. I said, you know, my co-host guy, John Dean, and one of the guys goes, Watergate guy?
Wow, really? You know, it's
But we're older.
Well, we are, yeah, and that's it. This guy was in his 70s, and he said, well, I'm probably one of the few that even remembers that. And I said,
think
yeah.
the gentleman that made the comment was maybe 68.
Yeah. Okay.
Yeah.
Well, that's about right.
Yeah.
That's about right. So anyway, not that I miss it. People for years would say, "Are you Watergate?" And they would all think they were the first ones to ever say it. You know, like I'd have to collapse in paroxysms of laughter, saying, "No one's ever said that before."
Now, this podcast is about learning and it's about education. So if you're listening to this thing, who's John Dean?
Yeah.
Look it up. Learn some history.
That's right. What is Watergate? What are you
What is
talking
Watergate?
about? I don't know what that is.
I spent the night in that hotel, 10 years ago now. But yeah,
I thought about staying there once.
I was a guest of somebody.
Okay, well, I thought about
I didn't
checking
pay
in
for it.
I thought about checking in and using my name, but I mean, they're not going to get it.
I
They're not
stayed at
gonna
the
say
Watergate
anything.
complex, which is condos. I'm part of it.
Yeah. It's the one time where I got a weird look was back in the 90s, early to mid 90s, and we had a guest on one of our talk shows in the radio station I worked for, and it was Gordon Liddy. Okay, G. Gordon Liddy, who was one of
G.
the
Gordon
people,
Liddy.
yes, who was directly involved in Watergate and the break-in and all that stuff. And I went up to introduce myself to bring him back to the studio. I said, "Hi, I'm John Dean," and honestly, he looked at me like he had this glare, this scowl.
Well, he had a good,
He had a
bad look.
balding, and he had
he could
eyebrows
give you a good snake eye.
that he put black. I mean, it was like kiwi black on the eyebrows to give him that stern look. And he gave me that look. And I said, no, that's my real name. I don't know how I got off on this. I didn't mean to get on that tangent, but you know what? Sometimes tangents are fun.
You brought up a very bad sitcom from the 70s.
Welcome back, Cotter. Look it up. That's another one you got to look up. And it was
don't bother.
horrible.
That's
it was
not good
horrible.
history.
Don't bother. It had a catchy theme song, which is why it made anything at all. Anyway, the topic du jour has to do with, once again, we talked last week about making your portfolio last, and trying to get it to...
Well, the 4% rule, then they use a balanced portfolio. Everybody wants to be in balance.
Yeah. And so we talk about risk as we approach retirement. And a question we used to get quite a bit was, well, how much should I have in stocks? I mean, if I'm only 4 or 5 years away from retirement or less, do I really need to have all this money in stocks? Because what if the stock market collapses and all this stuff?
Should I have all this money in stocks? Forget need. I'm 4 years, 3 years, 2 years from retirement.
Yeah. Should
I still be 100% invested in stocks? Not if you need the money from your portfolio and you want to make sure it's there.
Right. So target date funds, and I'm only guessing, I believe were established with this principle in mind, which is that the closer you get to your target year date of retirement, that you should be in you should own assets that are not necessarily equities. Am I saying this right?
I think they came out of the fact that Congress wanted to make sure that you didn't screw yourself up. They want it because people tend to do things, set it and forget it, and never do anything again until certain things happen. Retirement. Oh, now it's time for me to look at what my 401k is invested in. When I start, I'm going to start doing it. I don't know how to invest it. Congress was looking for a way to make it easy for you to manage your money.
So that
or to have your money managed for you.
So that when you the morning you wake up, your first day of retirement, you're not looking at a portfolio that supposedly
100%
crashed or whatever because the stock market went down. If they were really concerned, they'd give us more Social Security benefits. But oh no, we're not going to do that. Anyway, so I look at the target date funds as being sort of an official reaction to that.
And the idea is what you talked about. As we get older, the idea is that we can't afford to have all of our money in aggressive investments that have the potential for making more money. We need to pare back. And so as we get older, we go from when you're 20 years old, 30 years old, you have a 100% stock portfolio because you're not going to touch the money until you're 60. But as you go through your 40s, 50s, the shift becomes away from all stocks into more of a balanced portfolio. Now, when you're 40s, 80-20, 80% stocks, 90% stocks, 10% bonds. But as you get closer to your retirement, you should be at least less volatile. And so the idea is you don't want to sustain that 2007 to 2009 crash if you're retiring in 2009. Because then your portfolio went from the proverbial $1 million down to $600,000, and now you can't retire as well.
Right.
And so they wanted to be able to help people, government here to help, manage the money for them. So they created these target date funds. And the idea is that there's a date on the fund that the percentage of stocks and bonds or percentage of stocks compared to bonds will decrease as you get closer to that date. The further the date out, the more stocks, the more aggressive the portfolio is. The closer that date is, the less aggressive, the more conservative the overall portfolio is. And it's a shift from an mostly stock portfolio to a mostly bond portfolio through that time that you don't have to think about. Do you use the old rule of 100? You take 100 minus your age, and that's how much in stocks you should have.
Speaking of rules of thumb that should be broken, there's a
dumb
big
one.
Right.
So these target date funds were introduced, and they became a very big part of 401ks.
How do they work?
The idea is that as you get closer to the date, now they're basically the dates are in numbers of 5. So they're like 2020, 2025, 2030, 2035. There's not one for every year. It's one for every 5 years.
Okay.
And so you pick the date that you're going to want to start withdrawing money from the portfolio that corresponds with about the time that you're going to do that. If you're going to retire in 2025, 2026, 2027, you use a 2025 fund. If you're 20 years old now and you're not going to, this is, IRA money, 401k money, and you're not going to retire for 40 years, pick the longest one out there because that's going to be the most aggressive. And then as you age, the fund will automatically start reducing the exposure to stocks and have some mix that then becomes less aggressive as you get closer to that ultimate target date. I mean, there's nothing special about them, but it is a set it and forget it kind of thing. I don't like them for people that are retired and trying to take money from the portfolio. And I don't like them for new contributions going into the 401k, regardless of what your age is. But for somebody who wants their existing money, not the ongoing contributions, to have an allocation that is becoming less aggressive as you age, I guess it's okay.
Where it happens automatically.
It happens automatically. It may start off if 95% stocks and 5% bonds when it's a 2065 fund right now. And then as you get closer to that date, it'll become a 80% bonds than 20% stocks. So it shifts automatically. You don't have to do it. That's the goal. That's the idea.
So a 2030 fund is
we're about 8 years out from it.
Should have less a less risky allocation than a 2050 fund.
Yes.
That's the idea.
The 2030 fund would probably be somewhere around 60-40, 50-50 stock bonds, where the 2060 fund would be probably close to 100% stocks.
Yeah. And the idea is fine. It's probably, as you said, I guess, a good idea for some people.
For the person that wants to spend no time thinking about it, that doesn't want to talk to an advisor, doesn't care about it, and wants somebody else to do it for them. For the existing assets, if you have existing assets.
Now, having said all that, there are risks, and that's what I wanted to talk about here, because it sounds like, well, what kind of risks are there?
Well, the big problem is you don't actually know what or how they're investing, and you would think that multiple mutual fund companies offer these target date funds. Vanguard, Schwab, Fidelity, all of them out there have got basically target date funds, and you would think that, well, a 2030 fund from XYZ brokerage company or the 2030 fund from ABC, they're going to be similar, not necessarily.
Yeah, they can have totally different investment and risk profiles.
Very different. And so you don't necessarily know what you're getting. And how fast is the glide path? What they tell glide path is the percentage of stocks to bonds. Am I starting off at 80? How quickly do I get down to a more conservative area? And what happens when I do get to the target date? I was getting ready to retire 2020 this year, and so I used the 2020 fund. Have they done anything with that fund over the last couple of years, and where is it at now? So it for somebody who really doesn't want to know anything, they work there. But for somebody who wants to take a little bit more control over their investment life, I don't care for them that much. Now, as I mentioned before, I don't like them for ongoing contributions, and I don't like them for people that are taking distributions. Why would I say that? Well, for one thing, ongoing contributions should take advantage of the one thing we know the stock market's going to give us.
Volatility.
And if I'm going to retire in 2030 and I use a 2030 fund and it's 50, 60, 70% bonds, I don't have a lot of volatility. So I'm not using what the market gives me. But I dollar cost average my monthly contribution, my paycheck contribution to the stock portfolio, the long term, because the money if I'm retiring in the next 5, 6, 7, 8 years, the money I'm saving today is not for the year I retire. It's for later down the line
15,
somewhere.
20
it
years.
has the time to be able to accept the volatility. And I want to use that volatility to help me do dollar cost averaging and be able to, get some deals down the line when the volatility happens.
And we've seen that, and I don't know about when this podcast is coming out, but we've seen the volatility early on in
January was not a very good month, but
no.
I like the idea that my 401k contribution went in on the 30th.
Is that I don't know when the date was. Is that when it is?
That's when mine went in, so probably yours too.
All right, not bad.
So at least that dollar amount gets a little bit of, hopefully a little boost.
Well, you get to buy more shares.
I bought in at a fairly low point.
You bought more shares. So, but now here's the other thing about target date funds. And what you just said, by the way, is an excellent point, and we've talked about this in past podcasts, and I don't hear it a lot. But the other thing is that target date funds can lose money.
Oh, no, they're not guaranteed, for
right,
sure.
But I think there are people who think that, well, it's going to become more conservative, so there's no way it's going to lose money.
Well, no, they can lose money because it's invested at least some portion in stocks and then bonds. And bonds are not guaranteed. They can lose value too, depending upon what interest rates do. And so in the last big downturn, we had the last one that actually lasted more than 2 months was 2007 to 2009.
Yeah.
And so what if I was going to retire in that period of time? Well, then I would have been using a 2005, a 2010, maybe really conservative, a 2000 target date.
Right.
Well, if I'm retiring in 2008 and I have a 2000 target date, that should be about as safe can be, because my target date was 8 years ago. But that's not the way they work.
Well, no. Morningstar, I found this report, said back in 2008, funds with a 2000 to 2010 target date, so 2000, 2005, and 2010, those funds lost an average of 22%.
Right, because basically they're still a balanced portfolio. They're still invested. They're not in guarantees. They're not in CDs or anything like that, GICs, guaranteed investment contracts. Mm-hmm. They're in stocks and bonds. And what is the allocation? So that's another important question. When I do get to my target date, what is the ultimate allocation? It's not perfectly safe. It's not guaranteed. Mm-hmm. It still may be 75-25 or 25% bond or stocks and 75% bonds. There's still that 25% stock portfolio that could go down. So it could go down in value, even though I've met my date. And while they tend to move towards a more conservative point of view, as they get close to and reach their target date, once they've hit their target date, they keep that allocation forevermore after that. So you'll always have some stocks. You're going to be some form of a balanced portfolio from that point forward. And that's why the second area I said I don't like them for is pulling money out of the portfolio, because pulling money out of a portfolio that has the ability to go down, like what you just said, 25% on average in 1 year, 22%, that doesn't help at all. That blows last year's 4% rule discussion to the heck in a handbasket, because now I'm not taking anywhere near 4%. If I started at $1 million and I took out 4% and I lost 22%, now I'm down around what, 720,000, I'm down a lot. And now I'm still trying to take my $40,000 out of that, my 4%, but it's no longer 4%. It's like 6 or 7%.
Well, so what do I do if I have one of these in my 401k and I got to take money out of it? Should I have dumped it by the time it comes time to withdraw money? What do I do?
I don't have a problem dumping it, but you have to have an alternative, obviously. This is where we get into the planning prospect of, hey, if you want to keep that fund for the money you're not going to spend for 5 or 6, 7 years, fine. But let's identify what you're going to spend for the next 5 or 6, 7 years and put that in something more safe. And then let's identify what we're going to spend from year 6 to year 10, 12, 13, 14, 15, and we can use the target date for that. And then whatever's left over, use the 2050 for that. The 2070 for that if they're out now. I don't think they're out yet.
Interesting strategy. That almost sounds like a buckets type of strategy.
Yeah, it's amazing. You put bucket number one, safe.
Yeah.
So if I need $10,000 a year, I don't want it to go down by 22% where I can only have $8,000.
Instead of safe, maybe non-volatile.
Non-volatile. I mean, you can use CDs, you can use money markets,
okay.
you can use
right.
I mean,
guaranteed by FDIC stuff. Yeah.
Yeah, or there's different things out there you can use, but have enough money that no matter what happens to the market, your 10,000 is 10,000. Give up the idea that you're going to double it in a year to make sure that you don't cut it by a third
or half or whatever it is.
Yeah, but money that I don't need to spend for 15 years or more, now that can be in the pure stock market, but we have to identify it. This is where we do our modeling. This is where we do our projections, and we backfill the appropriate amounts of money.
Well, now, you said just a moment ago, and this is a very good point, once you hit your target date, maybe you're 20% stock, 80% bond, whatever it is, and it stays that way for the duration until you get rid of it.
You still have risk.
Well, you sure, because what if I've got 80% bonds, say, just to make it up, but interest rates rise during that time? Aren't my bonds going to lose value?
They are going to lose value. How much depends on how long they are and how much interest rates actually do rise, and how quickly they can turn them over and be able to get the new higher interest rate bonds, and at what premium are they paying for them, or things of that nature, and what discount did they have to sell the existing holdings to be able to do it. This is why people don't manage their own portfolios. This is what money managers get paid to do, but they're going to lose some money.
Well, and I've also read, and I believe we've talked about this, that in many or some circumstances, for some people, owning more stocks once you've retired, increasing your allocation to stocks as you're retired, may actually be beneficial. Have you heard that?
I've heard it. It's almost a byproduct, though, in that, I've asked the question many times in seminars that I do, who can afford to be more aggressive? Who can afford to have a larger percentage of their portfolio in stocks? A 65-year-old or a 95-year-old? And people are, well, the 95-year-old has to be super safe. No, they don't. They don't have to fund 30 years of retirement anymore. They hopefully have to fund another maybe 5 or 10. But the 65-year-old potentially has at least 30 years of funding to do. They need to be more conservative because they cannot afford to be taking money out of a down portfolio. The 95-year-old needs to keep enough money safe for the next 5 years, maybe 6, 7. But most of us are not going to make it to 115.
Be realistic here.
Yeah, and even 115 is only 20 years.
Well, that's true. So, which is why, and in a buckets type of strategy anyway, as you're spending down bucket one, you are kind of by default
bucket number 3, the growth portfolio,
increasing
as a percentage of the overall.
Yeah.
But that's when you monitor, you manage, and you say, let's take advantage of really good years and refill bucket number 1 at the right time. So we stay within tolerance of our spending needs without letting the
That's a bucket strategy discussion, but yes.
There are those that believe that over 15 years, after 15 years all you have is a stock market, you haven't touched it, it should be large enough that you could probably live on dividends alone. It'll only be like a 2% distribution. I'd rather be a little bit more conservative than that and refill on opportunistic times.
Right. So these are some of the risks with target date funds.
Yes.
They're not foolproof for sure.
Name one set it and forget it thing that works perfect for everybody.
Ron
Other
Popeil.
than Ronco, yeah.
Ron Popeil had
Bassomatic
an oven that you could set and forget. And I don't even know if that actually, maybe you needed to maintain it. So you could be stuck with a whole bunch of bonds for 20 years if you didn't touch it in this target date fund and be losing money because interest rates went up.
Right. And you're trying to draw money out of it. And each time you draw it out, your share price is lower.
And your reverse dollar cost averaging.
And reverse dollar cost averaging hurts.
Now, the other thing that doesn't get talked about a lot as far as hidden risks or whatever in 401ks and in target date funds has to do with the fees. I also looked this up.
They're hard to understand.
Well, what I read was the average target date fund has an expense ratio, well, it had in 2020, the expense ratio of 52 basis points.
Right.
Which...
That's pretty cheap, actually.
Well, but it's there. And I mean, it may not seem a lot.
But that's not the whole fee.
No, it's not. That's just the expense ratio.
For the target date fund. But the target date fund, they don't go out and buy individual securities for the most part to fill out their 60-40, 70-30.
No.
They buy mutual funds of that same mutual fund company.
They're called funds of funds.
Right. So they've got a small cap, large cap, mid cap fund. They've got a short-term bond fund, a strategic bond fund, a high yield bond fund. They've got all these different pieces of the pie that are other mutual funds. The 52 basis points that you were talking about, the 0.52%, was the cost for the target date fund to oversee all these other funds. But each of those other funds
has fees included.
Has an internal expense ratio of maybe 1% or more, depending upon what type of fund you're using. So is it the worst thing in the world? No, it's just something you need to be aware of.
If it doesn't bother you, then
don't worry about it.
But you absolutely have to be aware of that, and that can over time, I think, like any fee structure, if you're not aware of it, it can eat into your return.
Are you getting value for what you're paying for? That's basically the bottom line. Is this fund giving you the benefit of at least those basis points?
Well, yeah, and getting to this fee discussion, which may actually be a whole other topic that we could talk about sometime. I mean, are fees bad? Well, I guess that question, Professor Plum,
getting any value
is relative. What are you paying a fee for?
Yeah, if you're getting value for what you're paying for, that's the thing. I was just thinking something else about target dates I didn't like, but I can't remember what it was. It just went inside, went out the other side.
Well, maybe we should rewind the tape and go back to what we were saying. You did talk about the 52 basis points and the fund of funds and being in that. There are all kinds of fees within that.
I remembered what it was.
Go.
Target date funds. They also are basically presupposing that this is 100% of your money.
Oh, that was the other thing. Yes. It doesn't take into account the rest of your portfolio,
right?
Does it?
That could be invested either very conservative. Maybe you've got your bucket number one, your less volatile account taken care of with other sources, or maybe you've got more stocks in your other accounts that you don't want to sell, and so your overall allocation is thrown out of whack because it doesn't match. Maybe the target date has the perfect allocation for you, but you've got these other funds in your IRAs, your personal accounts, your trust account
that are different,
that totally throw your allocation off, and they know nothing about it, nor how could they? So if 100% of your money is in that one area, okay, then you can make an argument for it. But unless you have 100% there, you've got these other funds, they still need to be coordinated with your other funds. And that's why you may not want to use one that is related to your specific target date, because you may have the safe money already taken care of through other sources. Maybe your old 401k had a great stable value fund and you kept it. You've got the stable value fund for the first 8 years of your retirement.
You want the more aggressive one, you're saying.
So now you need to shift you need to adjust your target date, not to when you retire, but to when you might want to use the funds, which could be 10 years later. But that looks weird.
It's complicated stuff. Now, would you say that target date funds work better for people who are maybe on the younger side of life?
They're real easy because you can just pick the longest date. But on the other side, even the 2060 funds are going to have a small sliver of bonds in them. none of them are, I don't believe, not any that I've seen, are 100% stocks. And if you're 20 in your 401k, forget the bonds. You don't want any bonds there.
You're giving generic advice here, but I think it works in this case.
Go through and pick your own stock allocation, stock mutual fund allocation. Go through and figure out what's appropriate for you. Don't turn it over to somebody who doesn't know what you're trying to accomplish.
Yeah, can you think of a reason?
It's not the worst thing in the world. I mean,
aren't you kind of cheating yourself and potentially?
I think potentially, yes, you are. But that's me. For somebody who doesn't want to think about it.
Now, that's not to say, again, that, first of all, that somebody in their 20s and 30s shouldn't have safe money. I mean, there are things that people want to save for, I would guess.
Right, but we're talking about their 401k.
But we're talking
Target
about
date funds are primarily in 401ks.
Retirements, yes.
And if I'm 20 and 30,
yes,
the money I have in my 401k is not my safe money.
We're always on the same wavelength, which is exactly what I like. Because when I say something, you know where I'm going.
Yeah, it's like my emergency fund is not my 401k. If I want to build an emergency fund, I want to be outside of my 401k. I'm okay. This is going to sound weird. I'm okay using my Roth IRA for it. I want to be funding my Roth IRA. And somebody says, well, I haven't created my emergency fund yet. Okay, create your emergency fund in your Roth IRA until you can build up both areas. Because I cannot go back and remake up contributions to a Roth IRA from 2020, from 2019, from 2018. So if I'm putting my $6,000 away, if I can only put $5,000 or $4,000 away, I can put it into my Roth IRA and keep it as my emergency fund until I can max that out and then start building a personal emergency fund. If I have that emergency, I can get the money in a Roth IRA back. I've put, $4,000 in, I can get $4,000 back out and I can do it tax free because it's my money coming back to me. So I can use it for an emergency fund. I just can't use the earnings. But if I'm using safe accounts in there, they aren't earning very much anyway. And then as I go, now I've been building up $4,000 a year. Now I've got a little bit more money. I've built up an emergency fund on the real side. I can take that $20,000 and invest it rather than now start investing in my Roth IRA and only have $4,000, $5,000 to invest.
But you're giving away all these financial planning tricks that you use. This is really
it's just ideas,
stuff you don't hear. That's the stuff that you enjoy figuring out, though.
Yeah,
pieces of the puzzle.
That's mostly for the younger people I'm talking about too. Not
they have time.
Yeah,
they have time.
Not the 58-year-old with $2 million in their 401k. That's not advice for them.
Well, I guess that's another mistake some people make, though, that they're doing the same kind of planning at 58 that they were at 28 or 38 or whatever.
I run into a lot of people who are getting ready to retire and they haven't looked at their allocation in their 401k. We've told them, look, when the markets are bad, just don't look at your 401k. Just keep going, keep going, keep going. Well, they took our advice. They haven't looked at their 401k in 15 or 20 years. It's still 100% stocks, but they're getting ready to retire. Come on, you got to start getting ready for retirement.
Yeah, which reminds me, I got to look at my allocation now. If I really hope to retire in the next couple of years, I probably need to change things. So just kind of reiterating, we're not saying target date funds are bad. I mean, we've run over some of the risks here. Just to go back over these, we've talked about how different target date funds can have totally different risk profiles.
Yep.
Totally different
for the same target date.
Right, exactly. I mean, just go from one company to another one, and they're going to have different
allocations for
the same target date.
Yes.
There is no standard on that. They can lose money. We've talked about that. They aren't guaranteed at all. They don't take into account the other things that you have in your portfolio. Can throw off your asset allocation, can throw that out of whack. You don't always know what they're invested in. I don't know if that's a risk, but it's an unknown.
Yes.
And so you need to know what it is you're investing in. And then the target date doesn't change its allocation once it reaches the target date. There's risk there, especially interest rate risk.
There's fees you don't know about.
And then there are fees and all this stuff. So we've listed all this stuff. It sounds like...
But they can be used depending upon what else is available to you.
Strategically?
Yeah, I mean, just like anything else. If you know what they are, how they work, you can maybe make it work for you.
Yeah.
And then there's nothing wrong inherently with oh my gosh, run for the hills. It's a disaster coming. But if you use them correctly.
Well, you talked about fees and you talked about, are you getting value? There are certain products that have massive amounts of fees historically. And I won't mention them, but there are.
But they may have a guarantee of something, or they may have some bell or whistle that's worth the price.
Exactly. And
but if you aren't using that bell and whistle and never expect to use that bell and whistle, it's not worth the price.
Bingo. Man, you're on fire today. Really, this is
Got the fever.
This is Howard Hessman.
That was a while back. Sorry.
It was a while back.
I'm still mourning.
We're still all the people from our our I don't want to say childhood, but our young
youth?
years. He was 81. Did you know that? He was 81 years old. Wow. I was surprised. Klinger, Jamie Farr's in his mid 80s, I think.
Okay.
I mean, you don't think about that, but anyway. How did we get off on that real quick? That was something. Okay, so anyway, just to wrap this up, I guess the lesson is know what you're getting.
Right. Just take a few minutes to understand what you have, and if it works for you, fine. But just make sure that you know what you have.
And if you don't, if you have questions, or you read online that these are great, or you've read online that these are horrible, or you've heard a good idea is to check with somebody who knows. Professor Plum is one of those people. In many cases, he's studied it inside and out. Why?
Because I'm weird.
Because you're weird and because you like it. As we go to the Mickey Mouse Club thing. No, it's just know what you're getting. And this is all part of the planning process. If you want to talk to Professor Plum about your 401k allocation, if you haven't looked at it for a while, you're getting closer. If it's been 15, 20 years, and not just your 401k, I think probably your entire portfolio, because people's goals change, do they not?
Well, as you get closer to retirement, you want to know, are you on the right track? Are you in the right space? Are you protecting yourself and still taking advantage of what's available out there? And maybe you found out you could retire early, or maybe you find out that you need to make some adjustments in either in your spending or work longer. And unfortunately, it's better to find out when you have a few years left rather than the day you pull the plug.
For sure. And that's what planning means, thinking about this stuff ahead of time. That's why they huddle up before the play. They don't huddle up after and say, what went wrong?
Well, they do that too.
Well, they might.
But it's too late in some respects.
Well, it is.
When you throw an interception at the...
Oh, please. Oh. Anyway, could talk to Professor Rick Plum, 800-644-1150. I mean, you can talk to any of the Lucia Capital Group advisors. You guys work as a team.
Yep.
I've seen them collaborate, 3 or 4 people. You were doing. I was trying to get you to come in and do the podcast, but you were talking to 2 or 3 others. You guys were doing some strategy session over there. This is just what happens. But this is the good teamwork approach, and that's why I think if you talk to the folks at Lucia Capital Group, you get people like Professor Plum who can say, "Look, you know what? That may be conventional wisdom, but it doesn't work in your case."
Actually, I think when you saw us, we were talking about lunch. No, I'm kidding.
Well, it didn't sound like it. Somebody was talking about something. Anyway, 800-644-1150. I said that's the number at Lucia Capital Group. Find out if you're on track. It's that simple. You can also find us online, luciacap.com, LUCIACAP.com. Articles are there. You can read all this stuff. You can watch videos, past and present. Get all kinds of resources there. Talk to the folks there, and just get some knowledge. That's what it's all about. Also find us on Spotify. That's our podcast. Go there, subscribe to our podcast, do what you have to do to get it downloaded, because every single week, except for the little breaks in between seasons for a couple of weeks, you're going to get a new podcast, different financial planning topic, and these are important things right from the brain of Professor Rick Plum. Go to Spotify for that. Professor, thank you so much.
Fun as always.
It was fun. I don't know what we're talking about next week. We're going to have to get together and huddle on this before we do. But anyway, it's been a lot of fun. We will talk to you again next time. For Professor Rick Plum, certified financial planner professional, I'm your podcast host, Johnny Dean. Thanks so much for listening. We will talk to you again next week. Take care.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. Target date funds are subject to the volatility of the financial markets, including equity and fixed income investments in the U.S. and abroad, and may be subject to risks associated with investing in high yield, small cap, and commodity-related foreign securities. Principal invested is not guaranteed at any time, including at or after target dates. Before investing, carefully consider a target date fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. The principal value of a target fund is not guaranteed at any time, including at the target date. Stable value funds can be viewed as an alternative to money market funds. However, there are important differences, and stable value products can be complicated. Unlike money market funds, stable value funds are typically not registered with the SEC. In addition, they are not guaranteed by the U.S. government. The structure of or investments within stable value may vary, and it is important to consider these differences in selecting a stable value fund. Before investing, carefully consider a stable value mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk. Bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall, financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. The word guaranteed in the term guaranteed investment contracts, GIC, can be misleading. As with all investments, investors in GICs are exposed to investment risk. Investment risk is the chance that an investment may lose value or even become worthless. Should the insurer mismanage assets or declare bankruptcy, the purchasing institution may not receive the return of principal, the initial investment, or interest payments. Inflation or rising prices and deflation are other factors that may impact the value of the guaranteed insurance contract. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial. Schwab and Fidelity are not affiliated with Lucia Capital Group or LPL Financial.